Welcome back, everyone, to the Money, Metals, and Mining Virtual Expo. We are pleased to welcome Peter Schiff, Chief Global Strategist, Euro-Pacific Asset Management. Peter Schiff is one of the few widely known economists and investment professionals to have spoken about the financial crisis before it began. He is a widely followed opponent of debt-fueled growth policies and known for his advocacy for emerging market and commodity-focused investments in countries with positive fiscal characteristics. Peter, it's always a pleasure. It's all yours.
Thanks for welcoming me to the virtual Money Show. And I want to talk about gold. I know that a lot of people who have been attending the mining conferences over the past decade or so are probably pretty frustrated, given that gold hasn't made any real headway since 2011. Back then, I think gold topped out at around 1900, and we did manage to make a new high over the last couple of years. Right now, gold is just under 1800, so it's lower than it was back in 2011. And a couple of things have also happened during that decade that has added to the frustration of people who have been holding gold. One is the long overdue emergence of inflation. Now, of course, inflation's been there all the time, hiding in plain sight. They didn't call it inflation, they called it quantitative easing, but that's inflation. It's just a euphemism for inflation. It's a way to explain inflation without getting people upset, because if the Federal Reserve leveled with the American public and said our policy is creating inflation, the public would respond, whoa, I don't like inflation. I don't want the cost of living to go up. Can't you come up with a better idea than inflation? Well, they couldn't. That's all they had. They just came up with a better name, quantitative easing. And they liked it so much, they really did it 4 times, the last one following COVID. So we had a massive inflation of the money supply, yet the price of gold hasn't reacted the way a lot of people thought it might have. And of course, even during the years where everybody pretended we didn't have inflation because they pointed to the CPI, and that showed that inflation was around 2% or less, the CPI has been rigged. It's been designed to understate the true effect inflation is having on consumer prices. And so all along, prices were moving up a lot more than 2%. It's just that nobody admitted that, although I think the public had an idea that this was taking place. But now prices are rising so much faster than 2% that it's really impossible for the government statistics to hide it. Sure, if the government statistics are showing 8% inflation, it's more likely 16%, but 8% is bad. I mean, 16%, of course, is far worse, but even 8%, if inflation was that low, is still very bad. And of course, most people who own gold own it because of inflation. They're worried about the erosion of purchasing power of fiat currencies, particularly the US dollar, but other currencies, the euro, the yen. Central banks are printing a lot of money, they're running these deficits. And so people who understand this want to own gold to protect against inflation, yet the price of gold has gone sideways again for the last decade. And then the other thing that happened that probably frustrated a lot of people holding gold was the rise of Bitcoin, because Bitcoin rose from relative obscurity in 2011. Nobody really heard of it other than a few libertarian computer geeks who were buying it below $10 a Bitcoin. I mean, at one point they were pennies a Bitcoin, but for a while they were under 10 bucks. And it kind of really rose on the scene in 2017 when it went from 1,000 to 20,000. And that's when it got on everybody's radar. And Bitcoin was marketed by its proponents as a newer version of gold. It is gold 2.0. It's digital gold. It does everything gold does, only better, faster, cheaper. So this is the new version of gold. Gold is analog. Gold is a horse and buggy. Bitcoin is digital. Bitcoin is an automobile. And all forward-thinking people are buying Bitcoin, and if you're a dinosaur if you're buying gold. And for a while, Bitcoin prices just kept on going up. And they got as high earlier this year of just under $70,000 for a string of virtual numbers. But all the while, people that were holding gold were made fun of because gold wasn't going anywhere and Bitcoin was going to the moon. At least that's what everybody thought. And it certainly was on its way to the moon when it got up to 70,000. A lot of people put laser beams on their eyes in social media to signify that they were going to keep those lasers on until Bitcoin hit 100,000. Well, they're probably going to die with those laser beams on their eyes because Bitcoin's never going to hit 100,000 because the Bitcoin bubble has popped. But I think the deflation of the Bitcoin bubble is going to coincide with the next big move up in the price of gold. Because when people look at the last 10, 11 years in gold and they see sideways action, and then they conclude that, well, gold is no longer an inflation hedge, it's no longer relevant because it's not going anywhere, you have to look at the last 20 years. You can't just look at the last 10. You got to go back 2001 and see that gold was under $300 an ounce in 2001. And it went from under 300 to almost 2,000 in 10 years. That is a big move for the price of gold. Now, following that move, gold did have a significant correction. Between 2011 and 2015, it corrected down to 1,050, but it never got back below 1,000. And of course, it never went anywhere near the level below 300 where it began the bull market. So gold had a correction, and then it rallied up and made a new high by 2020 after COVID. And it's pulled back a little bit from that high, but it is really consolidating the big move up from 300 to 1900, been trading sideways. It is building a new base from which the next bull market is going to be launched. And what is delaying liftoff of this gold rocket ship is a misconception on the part of investors around the world as to the real situation with inflation in the United States and the Fed's ability to put the genie back in the bottle. Because for years, the officials at the Federal Reserve were telling us that the problem was we didn't have enough inflation. And they were going to solve that problem by creating more inflation. Well, they created a lot more than anybody bargained for, because now the problem is obviously much too much inflation. But when inflation first got to their 2% target, which used to be a ceiling, it was never created as a target, but it was reinvented as a target because the central banks wanted inflation, not because inflation is good, but because that was better than the alternative, which they were afraid of, which was deflation, which would have actually been better. But they needed inflation to keep the stock market bubble going, to keep financing government spending, to keep kicking the can down the road, which they really started to do in earnest after the 2008 financial crisis. But when inflation first got above 2%, instead of stepping on the brakes, the Fed said, we want inflation to be a little bit higher than 2% because we need average inflation to be 2%. We need to make up for all those years where inflation was a little less than 2%. We need to let it run a little hotter. We need 2.25% inflation. We got to average it out, as if somehow we have to be punished because prices didn't go up enough in the past. We have to make up for that by having bigger price increases in the future. None of it made sense economically, but the Fed had to come up with a justification for why it was continuing to print money and why it was keeping interest rates at zero, even though inflation was now north of its 2% target. Then when it got a lot above 2%, when you're looking at 4, 5%, 6% inflation, the next thing the Fed said was, well, this is all transitory. Don't worry about this. It's just related to the reopening of the economy. We were all locked down for COVID. And so this is just temporary. It's going to go away on its own. We can keep interest rates at zero. We can keep on printing money. We don't have to worry about this transitory inflation. Then, when it was obvious to everybody but the Fed that inflation wasn't transitory, they finally had to acknowledge that it was here to stay. But don't worry about it. even though it's not transitory, the Fed claimed they've got the tools. They are going to bring inflation right back down to 2%. Nothing to worry about. We got it covered. Yes, we were wrong about it being transitory, but don't worry. We can fix the problem. We've got these tools. And the markets believe the Fed. I don't know why, because they've never gotten anything right. So why do investors continue to assign any credibility to what they say? Remember, when the subprime market first blew up in 2007, what did they say? Don't worry about it. It's contained. Just like they said inflation was transitory. They always rationalize a problem. They never can see a problem coming or recognize it until it's a crisis. Well, by the time they recognized how bad inflation was, there is nothing they could do about it that is politically viable. They are so far behind the curve, even with all the rate hikes that they've had, and they've brought interest rates up to 4%. That doesn't matter. Inflation, even the way the government measures it, is 8%. You can't bring 8% inflation down to 2% with 4% interest rates. You have negative 4% interest rates. In order to lower inflation, you need positive real interest rates. So if inflation is 8%, 10%, 12%, something like that, the problem is nobody can afford to pay that kind of interest on the enormity of the debt, in particular, the federal government, which has a $31 trillion national debt. There's no way you can even finance it at 5% as all this debt is rolling over, let alone 10, 12% or something like that. In 1980, when Paul Volcker allowed interest rates to go to 20%, the highest the CPI ever got in 1981 was 13.5%. So he had 6.5% real interest rates to try to bend that inflation curve. We're nowhere near that. And of course, in order to reduce inflation, the Fed has to change the dynamics of savings and spending. Consumers have to be incentivized to save their money and not spend it. Well, how do you do that? Well, you give them the rate of interest that exceeds the rate of inflation, and maybe they'll save. But if you're only going to pay them 4%, and of course, that's if you buy a treasury bill, put your money in the bank right now, you don't even get 1%. So why is anyone going to save money when inflation is eroding away the value? They won't. They're going to spend the money as fast as they can, and that's inflationary. Also, you are encouraging more borrowing when you're pricing money below the inflation rate, because people are being paid to take on debt. So you're not going to get a reduction in consumption, which is necessary to reduce inflation, nor are you going to get an increase in supply of goods, because when people save more money, those savings are available to be loaned out to businesses to make more capital investment to raise the level of production in the economy. But we're not getting that. We're not getting more savings. We're not getting more production. I mean, our trade deficits have gone through the roof. They're at record highs because we are not increasing our capacity to produce. We continue to spend money. Budget deficits are near $2 trillion on the federal level. In order to combat inflation, we need to have cuts to government spending. We can't keep having stimulative monetary policy and stimulative fiscal policy, which is what we have. Yes, is the Fed's monetary policy as stimulative as it was when they were doing QE and when they had rates at zero? No, but it's still not tight money, and that's what we need. Meantime, the budget deficits that we're running right now are larger than any budget deficits we ran in the past, with the lone exception of the COVID year, 2020. So we have record fiscal stimulus, monetary stimulus. The inflation problem is going to get worse. But investors haven't connected those dots yet. They still believe the Fed. They still believe Powell when he says the Fed is going to do whatever it takes. It is resolute in its commitment to bring inflation down, and come hell or high water, we're going to do it. We're going to keep on raising interest rates until we win this fight. And the markets are believing the Fed. You can see that in the long end of the bond market. 30-year treasuries don't even yield 4%. So obviously, anyone buying 30-year treasuries does not expect today's inflation to exist at this level much longer. They believe the Fed will succeed in bringing it back down to 2%. But also, because of this, every time there's some type of evidence that the inflation problem isn't going away or is getting worse, the markets sell gold and they buy dollars. Why? Because they're afraid not of inflation, but of the Fed's fight to rein in inflation. And everybody just believes, well, if we're going to have this Fed that's going to get rid of inflation, I don't need to buy gold. I don't need to hedge inflation because the Fed's going to get rid of it for me. And while they're fighting inflation, they're going to jack up interest rates, and higher interest rates, well, that's bad for gold. And so the price of gold has gone down. But none of this is true because rising nominal rates don't make a difference to gold. What matters to gold are real interest rates. And as long as they're negative, that's positive for gold. And what the markets don't understand is that inflation's not going back down to 2%. It's more likely to go above 10% because what the Fed is going to bring down with its rate hikes is not inflation, but the economy, because this whole bubble economy has been erected on a foundation of inflation. The whole recovery from the 2008 financial crisis was built on inflation. And now that the Fed is trying to remove some of that inflation, you're taking away the foundation, everything comes collapsing down. Stocks are collapsing. Companies are going bankrupt that never should have existed. All the debt that never should have been taken out, that was non-productive and is now no longer serviceable at a higher rate of interest. The Fed is in the process of creating a much worse financial crisis than the one that it created in 2008. And so I think when investors start to appreciate the box that the Fed is in, that it's actually going to have to pivot, not in victory with inflation, but in defeat. The Fed is going to have to turn its attention to stimulating the economy. And the only tool it has to do that is inflation. Every problem that the Fed has tried to solve, it's done it with inflation. That's why this inflation problem is impossible to solve, because when your only tool is inflation, how do you solve the problem of inflation with inflation? You can't. This is a problem that the Fed can't bail us out from. And when the markets wake up to this, when the Fed has to go back to quantitative easing, even though inflation is nowhere near 2%, then I think the bottom is going to drop out of the US dollar, and I think gold's going to go through the roof. In fact, we've already started to see this correction. The US dollar index, which was bid up to almost 115 a couple of months ago, is now down to 105. That's a significant decline. The chart looks very toppy for the dollar. At the same time, gold has rallied. I think you had a major capitulation in this correction in gold. I think a lot of the institutional money gave up. They threw out all their gold stocks. A couple months ago, you had new 52-week lows in a lot of the big gold mining stocks, Newmont, Barrick, and to me, that was an exodus from the sector. Worst trade you could have possibly done. The smart money was buying up these gold stocks. They could read the writing on the wall. And I think that we're now going to see the simultaneous breakout in real gold and breakdown in fool's gold, because that's really what Bitcoin is. It's not gold 2.0, it's tulip mania 2.0. Gold and Bitcoin have absolutely nothing in common other than in the imaginations of its proponents. Yes, Bitcoin is divisible like gold. But who cares? Because when you're dividing gold, you're dividing something. When you're dividing Bitcoin, you're dividing nothing. Bitcoin can never be a store of value because it doesn't have any underlying value that can be stored. What the Bitcoin people never understood is gold's value as a metal. All of the valuable properties that gold has that allow it to be a store of value. Now, it has other properties that make it a better money than other commodities that have been used as money in the past and could be used. And Bitcoin tried to replicate some of those properties, but it missed the most important property of all, which it can't replicate, which is the actual value of gold, the metal. And Bitcoin, as it's collapsing, I think it won't be viewed as a competitor for gold. I mean, I think a lot of the institutional money that might have gone into gold didn't do it because they were persuaded that gold's future was in jeopardy because of Bitcoin. I don't think they were buying Bitcoin, but Bitcoin was just another excuse not to buy gold. Now, there were some people who probably bought gold instead of Bitcoin, and obviously they regret that. I mean, most of the people who bought Bitcoin have lost money very few people got in the early days. Most of the people who own Bitcoin bought into it in the last few years, and they're way down. And this most recent collapse of FTX, which follows some other high-profile bankruptcies in the crypto space, only shines a light on all the fraud that's been inherent in the entire sector. Now, a lot of these Bitcoin people will say, well, Bitcoin isn't crypto, but all that money going into crypto is what helped power Bitcoin all the way up to 70,000. And now, as I said, it's below 17,000, on its way much, much lower. And I think ironically, all these people in the Bitcoin space that said, oh, blockchain is the end of gold because now we have Bitcoin. I actually think that blockchain is not the end of gold, but a new beginning for gold. Because the proponents of Bitcoin, what they always argued made Bitcoin so much better than gold was that it was a better medium of exchange, that it was easier to conduct commerce in Bitcoin. After all, if you want to buy a cup of coffee, how are you going to buy it with gold? You're going to take a bar of gold into a Starbucks and you're going to shave off a little bit. You're going to try to pay. No, they said you could buy coffee with Bitcoin. The problem is you can't buy coffee with Bitcoin because the transactions are too expensive and too slow. And you can't price coffee in Bitcoin because it's too volatile. But you can buy a cup of coffee with gold if you use blockchain. This is what the Bitcoin community doesn't understand. And this is the future of gold, which is a gold that is going to be reintroduced into the monetary system by the private sector, not by governments, but by the private sector, and reintroduced as money because government money is failing. And as the inflation rates move higher, and there's no way these central banks are going to stop that because of the massive amounts of debt that they have. Nobody wants to raise taxes on the middle class. Nobody wants to cut spending and cut Social Security or Medicare. So the government is going to continue to pay the bills by creating inflation. And so anybody who has dollars is going to see a significant inflation tax eroding away their value. And the same may be true for people around the world. So they're going to be looking for alternatives to government money, just like people looked for alternatives to taxi cabs and they went to Uber, or they looked for alternatives to a hotel and they went to Airbnb, or they looked for alternatives to the post office and they started using FedEx. They're going to go back to gold as money, but they're not going to be carrying around their gold. The gold is going to be stored with a reputable third party, and that third party will issue a digital token like a Bitcoin that represents ownership of that gold. The original paper currencies that circulated in the United States were issued by private banks. The Federal Reserve wasn't created until 1913. We had paper money before 1913, but it was all issued by private banks and it was all backed by gold. And what gave the paper currency value was the gold in a vault backing it up. Well, today, you can issue currency backed by gold, but you don't have to do it on paper. You can use blockchain and issue it digitally. You could take a token that represents ownership of gold that's stored that can be transacted and used as a medium of exchange and a unit of account much faster and much quicker than you could use Bitcoin. So if I want to make a transaction over the internet, and let's say I want to buy something from somebody in Australia and I want to pay him, I can instantly send him gold. I don't have to send him the physical gold. That gold sits in a vault. What I send him is my ownership certificate digitally of that gold. And so the ownership of the gold transfers from me to the person in Australia, but the gold continues to sit in the vault. Maybe it's a Brinks vault in Switzerland, something like that, but the ownership changes. And that is, I think, where we're headed for a new gold standard adopted by the free market. Governments are not going to want to lead a return to the gold standard. The reason that we're not on a gold standard is because governments don't like it. Governments don't like it because it keeps them honest. It's like, kids don't like chaperones at the high school prom, but we have them there just to make sure things don't get out of hand. Well, that's why we're on a gold standard, because we don't trust government with a printing press. They're just going to keep on printing money. And when they went off the gold standard, that's when they enabled the government to start running bigger and bigger deficits and finance their spending through inflation rather than honest taxation. And because so many Americans thought they were getting something for nothing, they didn't push back against increases in government spending. But of course, if we stayed on a gold standard, we couldn't have run these deficits. And so taxes would have had to have been raised to pay for all these government programs. And the public wouldn't have wanted the programs if they thought they had to cover the cost. Everybody thought it was free. But as this inflation tax really starts to take a huge bite out of people's paychecks, out of their savings, people are going to look for alternatives, and the free market will supply it. Initially, the free market supplied Bitcoin because people weren't really looking for a store of value or for an alternative medium of exchange. They were content to use dollars. The demand for Bitcoin was from speculators who wanted to get rich. That's why people bought Bitcoin, so they can, get a Lambo. They pointed to all the people that got in and made a fortune, and hey, you can too. It was a pyramid, kind of Ponzi chain letter. There was no real demand to use Bitcoin as money. I mean, nobody used it as money. But there's going to be a demand to use gold as money. People aren't going to move to gold to get rich. They're going to move to gold to stay rich or just preserve what they have. And as inflation starts to really accelerate at a higher level, I think more and more merchants are going to want to move to a gold standard. They're going to want to get paid for their goods and services in real money, in gold. And with blockchain, that's all possible. That's all easy because you can break up an ounce of gold into tiny fractions. So you don't even need copper anymore or nickel anymore or even silver. You can do all your transactions in one metal, in gold, and you can do it quicker and cheaper than you can actually even in fiat currencies. It's easier than a bank wire. It's cheaper than using a credit card to make payments. And I think merchants are going to want to get paid in real money, especially as inflation is accelerating, because when merchants sell goods and now they have to go and replace them, if you get to a situation where prices are rising very rapidly, you could sell your goods for paper, and then before you get a chance to replace the goods you sold, it could cost you more to buy wholesale what you just sold retail. So in order for merchants to protect their purchasing power and to protect their margins, they can sell their products in gold, because as the price of their supplies, their wholesale prices are rising in terms of dollars, they'll be very steady in gold. They may even be falling in the price of gold. In fact, over time, all prices should fall slowly relative to gold. You have a deflationary monetary system when you have gold inherently. When we were on the gold standard in the United States, the consumer price index in 1900 was half of what it was in 1800. Now, why did we have a 100-year decline in prices? Because money maintained its value and the economy became more productive. And so you could buy more goods and services with gold at the end of the century than you could at the beginning. But of course, now that we're on this fiat system, we just have a constant inflation. Prices always go up, and they're about to go up a lot faster. So ironically, I don't think blockchain is the end of gold. It's basically going to give birth to the remonetization of gold, because I think that blockchain does for gold something that's far better than what the printing press did, because banknotes backed by gold made gold a better medium of exchange. It was easier for people who own gold to transact in paper. That's why governments got into that, and that's why governments ultimately took it over. But the money that made it all possible was gold. Paper just made gold more efficient as money. Well, a digital token or a digital currency is a huge advance to paper. It's much easier to transact in, much more difficult to counterfeit or lose. And in a global economy where people are transacting over large distances, back 100 years ago, 150, 200 years ago, if you bought something, I mean, you were in the same room as the guy who was selling it to you. So it was very easy for you to exchange your gold for whatever they were selling or your paper currency. But with today, with people are shopping online, and the merchants are in many cases not even in the same country, let alone in the same room, being able to transfer your ownership of gold electronically using the internet or blockchain or your cell phone, this is going to revolutionize the gold standard and really make government fiat currencies obsolete, because there would be no advantage to using dollars or euro or yen when you can use something that's better, cheaper, and faster. Gold is a much better store of value than any fiat currency. And now with blockchain, it's going to be an even better medium of exchange. And of course, it can be a unit of account. Merchants can price goods and services in gold, and it would be a global price that everybody could recognize and transact in. I don't know, how much time do I have to talk on this? I don't have a timer.
Yeah, we're at 45 after right now.
Oh, so this is pretty much my window, right?
Right.
All right. But anyway, so that's the news. I think it's good news for those of us who have been holding on to gold, and we've had to sit back and take all the okay boomer jokes from the millennials who thought they reinvented the wheel, and that wisdom had no value, and guys like me, we were just dinosaurs, we just didn't get it. Well, we're about to have the last laugh, and we're going to be rewarded for the foresight of understanding what was ultimately going to happen to fiat currencies. And the crypto people, they're going to see crypto become a reality in blockchain, only it won't be Bitcoin that is going to be utilizing the blockchain. It's going to be gold. Thanks, everybody.
All right, Peter, as always, excellent presentation. Great hearing you. Yeah. Look forward to hearing from you again shortly.
All right, take care.
Have a great one. All right, everyone, and thank you so much for attending Money, Metals, and Mining. It's a great way to wrap up the conference. Always a pleasure to hear Peter Schiff speak. So again, thank you so much for being here. Check out our next virtual expo. It will be December 13th to 14th. Just visit virtualexpo.moneyshow.com for more information there. Plus, be sure to go ahead and click around in the platform, visit all the exhibiting companies pages. You can download any materials, add those to your briefcase. You'll receive an email afterwards as well, so you can access those items. So again, if you want to catch any of these sessions on demand, also visit virtualpass.moneyshow.com, where you'll learn how to watch these on demand. So thanks again for everyone. The Money, Metals, and Mining Virtual Expo. We're signing off. Good night.